So welcome everyone. We will be starting the webinar in about a couple of minutes. Thank you. So hello everyone, and good afternoon, good evening, good morning, depending on where you're joining from. Thank you for joining today's webinar. As a quick introduction, my name is Naveen Aggarwal. I'm a corporate and international tax partner with KPMG, and I'm also the North India tax head with the India firm. We're delighted to have so many participants join for this important webinar to listen on this truly historic, I would say once in a lifetime development in the international tax arena, commonly now being referred to as a global tax deal, an agreement that has been reached by 132 out of 139 OECD G20 inclusive framework countries on the 1st of July 2021. There have been some very positive reactions to this momentous development. Richard Collier, who is the senior policy advisor at OECD, has termed this global deal as an avalanche of a hyperbole. The UK Chancellor, Rishi Sunak, has even gone as far as to suggest that we have reached a perfect state of international tax nirvana, such that the right companies pay the right amount of tax at the right place. Of course, closer home, the Finance Minister of India has made a calibrated statement saying that more work needs to be done to ensure that a fairer, stable, sustainable, and inclusive international tax system comes as a result of this and ensures meaningful revenues for developing countries. So in today's webinar, we're going to go through some important elements of this two-pillar package, BEPS 2.0, two-pillar package, two-pillar approach. We will cover an overview and some salient features of each of these pillars. What are some of the key considerations and impact for India, for global MNCs that have business interests in India, and also for India businesses which have outbound operations and structures? What is going to be the path to implementation? What are some of the implementation timelines? And some key action points for multinational groups. The way we're going to run this webinar is that it's going to be a mix of presentation and panel discussion. I have my panelists here on this webinar. We'll be taking up questions in between as well as towards the end of the session. So please feel free to type in your questions in the Q&A tab, and we'll be happy to address as we go along. So moving to the next slide, let me start by introducing my panel today. Joining me today is Conrad Turley. Conrad is a tax partner with KPMG China. He's also the Asia Pacific Regional Tax Policy Leader. Conrad is a key expert on tax policy matters. He's been quite closely involved on the OECD BEPS developments from its very inception, and has also been engaged with policymakers both at the national level and international level. So it'll be interesting to hear Conrad's perspectives around this two-pillar approach, what he is seeing as challenges, as also help us crystal ball gaze on what could be the realistic implementation timelines. We also have Hariharan Gangadharan, who's a partner and tax technical leader with KPMG in India, who would take us through the construct of the two pillars, some open issues, and some key considerations from an India standpoint. And lastly, we have Hasnain Shroff, who's a senior transfer pricing specialist. Hasnain would enlighten us on the key issues and watch points under both pillars, specifically under pillar 1 from a transfer pricing perspective. Okay, moving on to the next slide, please. As you can see from the slide, the timeline on the slide represents a 10-year journey, which started way back in 2013 with the launch of the base erosion and profit shifting project by the OECD G20 countries. And that was designed to address issues around tax planning strategies used by multinationals to exploit gaps and mismatches in tax rules to avoid paying tax in jurisdictions. Now, one of the key elements of the BEPS project was to address the tax challenges arising from digitization of the economy, which was enshrined in the Action Plan 1 of the 2015 report. And these challenges were largely on 3 counts. There were large businesses that were able to operate in another jurisdiction on a scale without having any mass. There was a significant importance to user contribution, which was not getting taxed. And there was heavy reliance on intangibles. Now, at that point of time in 2015, when the 15 action plans came out, there was no clear consensus on Pillar 1, but it was very clear that it was difficult to ring fence the digital economy. Now, between 2015 and now, a lot of intense negotiation took place between countries. There were compromises on all sides. And finally, this has resulted in a joint statement being issued in 2021, in July 2021, where 132 out of the 139 countries have agreed to this two-pillar reform package, which seeks to modernize and reform the existing tax rules and ensure that multinational enterprises pay a fair share of taxes where they operate. There are a lot of events which are going to happen between now and when this is going to get implemented in 2023, and we'll talk about that a little later in this presentation. Moving to the next slide. Just to give an opening context to what these two pillars are all about, the Pillar 1 basically aims to ensure a fairer distribution of profits and taxing rights among the market countries. Market countries being countries where customers and users are located. And this is essentially using a formulaic approach. In some sense, this also vindicates India's position on the importance of demand side factors and not just restricted to production, technology, and capital. This is actually a significant departure from international tax rules that we've all known about for the last 100 years and moves away from the idea that taxation largely requires a physical presence in a country before a country has a right to tax. It is estimated that this will apply to 100 of the biggest and most profitable multinational enterprises, having over euro 20 billion of global turnover and profitability above 10%. But we're not sure whether that's the correct number, because if we include private companies, possibly this number may be even higher. Pillar 2 has a slightly different focus and subjects a larger canvas of multinational groups, and this list may actually run into thousands, to a global minimum tax of at least 15%. And this is the reference to at least 15% means that there is no final agreement on this. The final agreement is likely to happen in October. And the threshold under Pillar 2 is much lower. It is for revenues exceeding 750 million euros. It is a coordinated set of rules to address profit shifting and also to prevent unhealthy tax competition, what we commonly refer to as a race to the bottom, which is being adopted by jurisdiction to attract foreign investment. Now, Pillar 2, as you can see on the slide, rests on the principle of what is referred to as tax back, which is where other jurisdictions have not exercised their primary taxing rights, or if the income is subject to a low rate of tax. Now, this is where the group, a multinational group, will have to look at every jurisdiction where it has operations and to determine where the effective tax rate falls below the 15% threshold. If it does, then a top-up tax will need to be calculated and paid. Additionally, there would also be specific intra-group payments made to related parties which are in low-tax jurisdictions that may be subject to new withholding taxes. We will get into more details on both these pillars, but as per the OECD estimates, Pillar 2 is expected to generate close to $150 billion of additional revenue, and Pillar 1 will result in reallocation of taxing rights to the extent of $100 billion in favor of market jurisdictions. So before I hand it over to Hari to talk about the specifics of Pillar 1 to begin with, let me invite Conrad to share his thoughts and perspective on the significance of this BEPS 2.0 initiative and what it means for cross-border taxation generally. Conrad, your thoughts?
Many thanks, Naveen, and many thanks for the invite to speak on this call today. Well, I think for this preliminary section where we're looking at the timeline, we're looking at the key elements of Pillar 1 and Pillar 2, I think one of the things that is most striking is the ambition of the timeline. They're looking to have both Pillar 1 and Pillar 2 in effect from the start of 2023. So on the prior slide, you had finished up in July, where we had the Inclusive Framework Agreement and its endorsement by the G20 Finance Ministers. In the next weeks, we need to get to a position where the G20 Finance Ministers can sign off on a full package of rules. So I suppose one of the key questions in people's minds is, will that be possible? Certainly the ambition is there, and certainly, as we understand it, great progress has been made on the technical work on Pillar 2, as we understand it, more to be done on Pillar 1. There are many complex aspects to that. So when there is and we presume there will be a sign-off in October, what will be released at that time? Will we see detailed documents released, detailed model rules, detailed guidance that will be put to consultation? Or will we see an update of the framework that was put forward? Will we see a mix? Perhaps for one of the pillars, we may see some detailed documents. For another pillar, we may see a framework. And then on what time frame do they plan to finalize all of this? Because on the assumption that the very ambitious timeline is to be achieved, effective date from the start of 2023, 2022 is an incredibly busy year. Tax authorities have to train their officials, build new systems, put new information exchange mechanisms in place, come up with new filing systems, and also new forms of attestation, whereby companies can show that the systems that they've built to collect the data, to process the data, meet the standards required by the array of tax authorities that will be looking at this. And I suppose one of the key aspects of, probably the key aspect of BEPS 2 is how it moves the global tax system from one in which multinationals are dealing one by one with tax authorities, and in most cases, with two tax authorities at once, let's say under a bilateral APA, to one in which they are truly dealing in a multilateral basis with tax authorities, dealing with all of their relevant tax authorities at once. So this is really a massive change, and the time frame is incredibly ambitious. So it's very much a case of watch this space to see how fast this moves.
Thanks, Conrad. Very, very interesting comments, and I would agree this is a very ambitious task of achieving the timelines, keeping in mind that we have already gone through BEPS 1, where we talked about a multilateral instrument, and out of the 95 countries that have sort of come on board, we have only 65 countries that have so far submitted their MLI instrument. So here we're talking about 132 countries, and this list might actually go up, getting to a final consensus, and of course getting into the details of what will get implemented. So with that, let me move to the next section of the presentation, and I hand it over to Hari. Hari, if you could cover the salient features of Pillar 1 and the relevance in the Indian context.
Sure. Thanks so much, Naveen. Thank you, Conrad, and good afternoon, everyone. Now, before we dive into the specifics of Pillar 1, let's spend a couple of minutes talking about its evolution and identifying what its broad objectives are. We all know that in 2013, the BEPS project Action 1 talked about dealing with the tax challenges of the digital economy. We saw the final report of 2015 identified 3 possible options to deal with this. One of them was the significant economic presence. One of them was a final withholding tax on digital payments. And lastly, we have the equalisation levy, which of course we in India are more familiar with. All these options were of course laid out subject to the understanding that they were not being recommended, but countries could adopt them under domestic law provided they did not violate their treaty obligations, or they could incorporate them under their bilateral treaties. And the report also talked about further work to be done to address these challenges. And what we're seeing now in terms of the Pillar 1 proposals is really that process of further work being done play itself out. There were a series of reports between 2015 and 2019 which took the process along. But the next major development really was the blueprints that came out in October of last year, which set out some proposals for shifting the way profits are allocated between countries of residence and the market jurisdictions. The one important distinction between what we saw then and what we saw and what we have today is in terms of scope. The 2020 blueprints talked about the new rules applying to companies that are engaged in providing certain kinds of digital services, as well as certain companies that are focused on consumer-facing businesses. The idea was that we would have a threshold of about 750 million, and it would cover these 2 kinds of companies. What we saw in the most recent statement that came out last month, it eliminates this distinction between ADS and consumer-facing businesses on the one hand, and makes Pillar 1 applicable across sectors without any distinction as to whether they are engaged in ADS or consumer-facing businesses or anything else altogether. There are carve-outs envisaged for some sectors, of course, but we'll talk about them later. The other big change that's happened is that this threshold of 750 million that was envisaged in the 2020 blueprints has now gone. And what we have now is a set of rules that are intended to apply to companies, to groups that have a consolidated turnover of more than 20 billion euros, coupled with a profitability threshold of 10%. So the scope has broadened, but the coverage may have reduced in terms of the number of companies covered because of this monetary threshold and this profitability threshold. Now, what exactly are these rules trying to achieve? In a nutshell, we have traditional rules involving creation of a permanent establishment, which typically tend to be based on physical presence. We had a set of attribution rules that were based on FAR. Both these are sought to be done away with under the proposals. And what we have today is a new nexus rule for these covered companies. And this nexus rule creates a taxable presence based solely on the amount of revenues that a company or a group generates from a particular market jurisdiction. The second point, of course, is that when it comes to attribution, the Pillar 1 proposals talk about a simple formula-based calculation rather than go through the ALP process, and talk about a formula that will help determine what is the amount of tax on which a multinational group would have to pay in a market jurisdiction. This really is the essence of Pillar 1. But as you can imagine, there's a lot of complexity in the detail. There is a lot of detail, and we will try and summarize them for you over the coming slides. Could we move to the next slide, please? Now, there are three key components to Pillar 1 that we will be talking about today. The first and the most important one is what is called Amount A. And Amount A really refers to that portion of a multinational group's residual profits that get allocated to the market jurisdictions under this entire process of the Pillar 1 proposals. What this means is that if there is a multinational group which earns revenues from customers in India, then India gets a right to tax a certain portion of the residual profits of that multinational group. And the amount of profits that India gets to tax is what is called Amount A. A lot of the detail, a lot of the complexity in the Pillar 1 proposals all revolve around how this Amount A is to be calculated and how will countries go about taxing these amounts, how will credit be given for these amounts and so on. And we will be spending a bulk of our time on today's call talking about the aspect of Amount A. As I mentioned earlier, this Amount A applies only to the largest companies which have a consolidated revenue threshold of over 20 billion euros, along with a profitability threshold of 10%. And we will talk more about this a little later. The next component is what's called Amount B, and this is really intended to be a simplification measure. Now, what Amount B seeks to do? It seeks to standardize the remuneration that related party distributors get for performing baseline marketing and distribution activities. Now, unlike Amount A, which is intended to be a formula-driven exercise, Amount B will be aligned with the arm's length concept. It's expected to provide certainty. It's expected to minimize disputes. And because of its nature and scope, it will apply to all companies that perform these kind of services and not be confined to the largest companies the way Amount A is intended to be confined. And because we are talking of calculations, because we are talking of something that, as Naveen mentioned, is a very radical departure from the existing international tax architecture that we're all used to, and considering that this entire calculation of Amount A is a calculation that's done at a group level rather than at an entity level, there is a significant potential for uncertainty. There's a significant potential for litigation. So to address these, the proposals envisage putting in place mechanisms meant to prevent disputes, meant to resolve disputes. And it's expected that these mechanisms will be binding as well as mandatory. So even countries like India, which have traditionally been wary of accepting international arbitration, will have to join in as part of the dispute resolution mechanisms that's envisaged under Pillar 1. If you could move to the next slide, let's talk about the scope of the Pillar 1 proposals. As I mentioned earlier, the last year's blueprint talked about a revenue threshold of 750 million. Now, had this been adopted, a much larger group of companies would have fallen within the ambit of the Pillar 1 proposals. But this has changed. now it applies only to companies that have a consolidated revenue of 20 billion euros in a particular year. And as a result, the universe of companies that falls within Pillar 1 is quite small, and of which an even smaller number, only a handful, would be India headquartered groups. In addition to the revenue threshold, the Pillar 1 rules also envisage a profitability threshold. And this profitability threshold is needed because Pillar 1 is intended to give market jurisdictions only a share in the residual profits and not a share in the total profits. So residual profits for the purposes of Pillar 1 is defined as profits in excess of 10%. And these are calculations that are based on accounting profit before tax. So what this means is that if you have a group that has a turnover of more than 20 billion euros, but a profitability of below 10%, then there is really no residual profit at all, which is available for distribution to market jurisdictions. And therefore, there's no point in going through the rest of the Pillar 1 calculation exercise in such cases. The one other point to remember when it comes to the thresholds is that these thresholds are again not frozen permanently. It's expected that based on a review process that will be undertaken after a certain number of years, the threshold of 20 billion could come down to 10 billion euros. This is expected to be 7 years after the Pillar 1 comes into force. So assuming the timelines that Conrad talked about are followed, then we're looking at something at these changes coming into effect in the early years of the next decade. There is an exclusion envisaged for certain sectors. Currently, the statement talks about extractive industries and financial services industries being out of it. Of course, these are not blanket exclusions. There will be definitions provided, there will be conditions attached, and we would have to go through those conditions to make sure that extractive industries or financial services qualify for this particular exclusion. There were certain other sectors that were also being considered for an exclusion. These included construction, infrastructure, international shipping, and aviation. But for now, it doesn't look like there is an exclusion envisaged for those sectors. And the exclusion is limited only to extractive industries and certain regulated financial service sectors. Can we please move to the next slide, please? Let's now quickly talk about how amount A is to be calculated under these proposals. Now, as I mentioned earlier, this entire calculation is done at a group level. It's based on consolidated financial statements. And the first step of this entire process would be to determine the residual profits, which is deemed to be profits in excess of 10% of revenue computed on the basis of the books of accounts. Of this residual profits, the profits in excess of 10%, somewhere between 20 and 30% of the profits will be allocated to market jurisdictions that satisfy the nexus requirement. So this is important. There are two components here. One point to note is that what goes to market jurisdictions is not the entire residual profits. Market jurisdictions get a share of between 20 and 30% of these residual profits. The second point is that not all market jurisdictions get it. The right to tax amount A goes only to those market jurisdictions where the group has a taxable presence, which will be computed under the new nexus rules that's again part of the Pillar 2 proposals. Now, unlike past proposals, and we saw that even the significant economic presence rule that was envisaged in the 2015 action item, which envisaged multiple factors that would help determine if a taxable presence is created. For instance, that report talked about revenue factors, of course. It talked about user factors. It talked about digital factors. None of that finds place in the final Pillar 1 statement that we saw last month. The only basis on which you would create a taxable nexus in a jurisdiction depends on how much money you make from that jurisdiction. So in a sense, revenues earned is the sole determinant of whether you create a taxable presence in a jurisdiction or not. In some sense, this is quite similar to what we have in India under our new significant economic presence rules that came into force from this financial year onwards. We have an INR 2 crore threshold, which comes to approximately 230,000 euros per year. The Pillar 1 thresholds are higher. They envisage a 1 million euro revenue criteria in order to create a taxable presence, which is of course higher than what we have under SEP, but it's not that much more. It's only about 8.5 or 9 crore odd rupees. So what we are talking about is, because this entire rule focuses on identifying and creating a taxable presence based on where revenues come from, it's also important to put in place rules that will help us figure out where revenues are sourced from. And this again is going to be a subject matter of a detailed set of rules that will form part of the final proposals. So, for instance, these rules could provide that advertising income is to be sourced with reference to the location of the viewer. Services income is to be computed with reference to the place of consumption. When it comes to sale of goods, it could be the place of final delivery. So you will have a series of rules that will lay down how you will source particular income. And once income is sourced to a particular jurisdiction, we will look at the aggregate of revenues which are sourced in that jurisdiction to see whether that's crossing the 1 million euro threshold needed to establish a taxable presence. Now, once this amount A is calculated based on this formula, and we will take a simple example in a later slide, the next question that comes in is who will pay the tax on amount A? You would have noted that until now, the calculations that we spoke about, they all happened at a consolidated global level based on financial statements, and we haven't really talked about individual legal entities at all. But we know that when it comes to reporting, when it comes to compliance, and when it comes to even enforcement, most countries still operate on the basis of entity-wise obligations. And as a result, there will be rules envisaged under Pillar 1 that will help identify which entity or which entities will bear this tax liability under Pillar 1. Typically, it is expected that those legal entities which earn the residual profits will be the ones that will have to bear the burden of amount A taxation in a market jurisdiction. There will also be rules to eliminate double taxation and credit or exemption, whatever is the preferred method in a particular jurisdiction, that will be allotted, that will be followed to avoid double tax. In addition to this, we will have the amount B calculation, which, as I mentioned a little while back, provides for a sort of a simplified safe harbor type approach to calculating the return for baseline marketing and distribution activities. The one point to note here is that unlike Pillar 1, which is expected to unlike amount A, which is expected to have a final consensus later this year, work on amount B is expected to continue until next year. And we are likely to see that this will get ready only by the end of December 2022, and not along with the rest of the Pillar 1 proposals. Can we move to the next slide, please? Now, on implementation, we spoke of the need for certainty and how countries have to commit to binding dispute resolution and binding dispute prevention mechanisms. The one important point to note here is that these dispute resolution and dispute prevention mechanisms will apply not just for the actual amount A calculation, but also for other issues that are related to amount A. So potentially this could cover transfer pricing issues and attribution issues, etc. And this could affect the way the domestic dispute resolution framework in India operates quite drastically. And this is a point that we will talk about a little later in detail with both Hasnain and Conrad. The other important point, and I think this is really the most important impact of the Pillar 1 proposals from an Indian perspective, is the commitment that's given by the Inclusive Framework members to remove digital services taxes and other relevant measures on all companies. So from an Indian perspective, this of course includes the equalisation levy. And there has been an ongoing debate about whether what India would get under the Pillar 1 calculations, the increased allocations under the new amount A, whether that would be whether that would make up for the lost revenues that would arise because of the repeal of equalisation levy. There are two other related points connected to this particular obligation that we will talk a little more, and we'll have Conrad weigh in on that a little later. The first of that is the timelines for withdrawal of unilateral measures and whether they'll have to take place immediately when the consensus comes into effect, or whether there will be a bit of a transition period that companies are entitled to, that countries can take advantage of. The second point, which is also an important one from an Indian perspective, is whether this obligation is limited to merely repeal of DSTs or other measures by India when it comes to source-based taxation would also get affected by this. And we will talk about this point a little later on as well. In terms of the process itself, the implementation of Pillar 1 is expected to take place through another multilateral instrument, which will be developed and which will open for signatures in 2022. And the amount A component, as Naveen mentioned earlier on, and Conrad also mentioned, the ambitious target is that these proposals will come into force in 2023. We move on to the next slide, please. Now let's take a very simple example of how amount A is going to be calculated. So we have here an example of a fictional group that has a total revenue of say $100 billion and profit before tax of 30 billion. Now all of these are financial account numbers. We are not talking about tax numbers at all for the purposes of this discussion. Because the profitability is 30%, the profit is in excess of the 10 billion profitability threshold. The revenue threshold is also met because the revenue threshold is 20 billion, and here we have the group having revenues of $100 billion. So both these thresholds are met in the SPAC pattern, and therefore amount A obligations start kicking in. The first step, as we mentioned, would be to calculate what the residual profits are. The residual profits in this case would be the 30% of actual profits, which are in excess of the 10% threshold for residual profits. So that gives us a $20 billion residual profits in this for this particular M&E group. What happens next is that some percentage of this residual profits gets allocated to market jurisdictions. That number is expected to be between 20% and 30%. So for the purpose of this example, if we were to assume that the ultimate consensus comes up with a number of 25%, what would mean is that 25% of this $20 billion euros gets allocated to the market jurisdictions, which means that 5 billion of profits becomes taxable as amount A in the market jurisdictions under the Pillar 1 proposal. So that's really the change from before. And if there are more than one market jurisdiction from which these revenues are earned, then each market jurisdiction gets to share in the $5 billion amount based on the quantum of revenues that are generated from each of them. So that's again a simple revenue-based allocation formula. So this really is a very simple high-level calculation of how the Pillar 1 calculations will work and how amount A will be calculated and then allocated between various market jurisdictions. We now move on to how Pillar 1 impacts, particularly in an Indian context. We can really divide this discussion into three buckets. The first is in terms of the actual cash outflows that companies will have to bear because of amount A. So large overseas multinational groups which earn significant revenues from India could see increased tax payouts in India, but this again would depend on what their residual profits are and the relative proportion of their revenues that they earn from India vis-a-vis other jurisdictions. This could also affect outbound structures because Indian headquartered groups could end up paying tax in market jurisdictions abroad under these proposals as well. Of course, this will, because the threshold is fairly high, this will affect only a handful of Indian companies for now, but that's something that could change as Indian companies grow or as the threshold itself comes down to 10 billion in the early part of the next decade. From an overall cash outflow perspective for Indian groups, the amount of tax that's paid by them overseas will be available as a credit under Indian law. So ideally, there should be no double taxation, but it would mean an increase in compliance obligations, an increase in reporting, and an increase in information gathering activities, which we will again talk about a little later. The second bucket of how Pillar 1 could impact Indian businesses is the impact on unilateral measures. So we would have to consider not just the impact that Pillar 1 has on equalization levy, but also on other unilateral measures that India has in place, including significant economic presence, the broader permanent establishment definitions that we have under some of our treaties, the general approach that we have in India of trying to give a very expansive meaning to the terms royalty under tax treaties and so on. So all of these may have to be, all of this could potentially be impacted in some way by the Pillar 1 proposals, and we'll talk about that a little later with Conrad and Hasnain. And lastly, the last bucket is to factor in the impact that this could have on unilateral levies that Indian businesses may be paying abroad. It could possibly happen that these unilateral levies are terminated as a result of the obligation under Pillar 1, and many Indian companies that pay them are not large enough to fall within the ambit of amount A. So there could be no increment, there could be a tax benefit for those companies as well in such situations. So that brings me to the end of my slides on Pillar 1, and I'll hand it back to Naveen, who will talk a little more about Pillar 1 in an Indian context, along with Conrad and Hasnain. Naveen, over to you.
Yeah. So thanks, Hari, for a very comprehensive coverage on the Pillar 1 proposals. And I probably pick up from where you left off, which is basically around the unilateral levies. And I think that's the sort of the big issue that is confronting India right now, especially because the needle has moved as far as Pillar 1 is concerned from where things started off in terms of taxation of the digital economy to ADS, CFP, and now looking at a much broader scope where it only extends to a limited group of companies that have a turnover more than 20 billion euros and 10% profits. And in contrast, what India would envisage collecting through equalization levy, which a much broader limit would be much higher. So my question to Conrad, you is that do you see a full withdrawal happening? Obviously, that is the stated intent, that every country withdraws the unilateral levies, but do you see a full withdrawal coming up? And if it doesn't, then could this pose to be a barrier in the final consensus? Or could India actually look at partially removing equalization levy only for those companies which actually fall within the scope of Pillar 1?
It's a very good question. Well, I suppose and you'll be closer to the Indian policymakers, but I'm certain at the Indian policymaker level, as in other jurisdictions, there's intensive modeling exercises going on at the moment of how much additional revenue comes in as against alternative measures that could be used, like equalization levies or DSTs in other markets. And certainly we're aware of many of the major economies that are doing such modeling exercises with a lot of factors coming into play. So, for example, assumptions would need to be made around the final form of the sourcing rules and how this interfaces with inbound activity in India across different sectors and different business models. So to give an example from the China context, I'm based in China, work for KPMG China. And one of the key considerations here would be the manufacturing sector. Obviously, China, a major global manufacturing center, and many multinationals that would be within the scope of the Pillar 1 rules would produce things like components, microchips, intermediate materials that would then be sold to China. So if the sourcing rules stop at the location of processing, then they will source the revenue to China. And so the amount A would be allocated to China. And so the other possibility is that the revenue would be traced on through the final products to the final markets where the final goods are consumed after processing. So China and other jurisdictions, the European jurisdictions, the United States, perhaps India as well, are modeling for this given their own industrial structure and their assumptions about how the rules work, to see how much do they stand to get through these rules, and is that better than the alternatives they have. I would have said that another key issue is there's a feature in the rules, that the marketing and distribution safe harbor, and that's a key element because depending on how that's designed, it determines whether a country is considered to already have been allocated enough profit through existing transfer pricing rules, and whether they'll get anything further through the amount A rules. So that's, I think, another key consideration in any modeling exercise, as is the question of withholding taxes. And I know Harry made mention of withholding taxes before, but will withholding taxes be creditable against amount A in the final rules? If they are, then that may limit the amount that India and other countries get from amount A. If they're not creditable, maybe that enhances the amount that is received from amount A. So I think all of these things, together with, I suppose, the broader question of where does the incidence of the taxes go? It could be perhaps for the equalization levy, the incidence is shifted by big digital platforms to their customers. Certainly in a European context, many of the big digital platforms said that if European companies brought in the DSTs, they would then renegotiate their arrangements and charge higher fees. Perhaps that can't be done in the same way for amount A. So if this economic incidence analysis is taken into account together with a kind of a scenario planning analysis on amount A, who knows, perhaps the Indian authorities would determine they're better off under amount A or better off under equalization levy. So this is a process I think most governments are still heavily involved in determining.
Right. No, I think that's valid points there. And of course, the government would be doing a whole lot of evaluation, especially because we've seen three versions of equalization levy, and each version obviously has only broadened the scope. So I think that evaluation exercise becomes extremely critical. Moving on to other forms of unilateral levies, and we've seen that apart from equalization levy and DSTs that we've seen in other countries, there are other unilateral measures also at play here. And for instance, Hari spoke about the significant economic presence. Of course, the significant economic presence is under the domestic law, and then we have the treaty, which provides for a narrow remit. So in that sense, it doesn't sort of apply to that extent to the treaty countries. But the scope is much broader in the context of how this will apply to 132 odd countries, of which all of which, in that sense, India may not have a bilateral treaty with. So how will this impact all of the other unilateral measures that we see? Any thoughts on that, Conrad?
And again, a very good point, because the inclusive framework statement, which in fairness was a very short document, only 5 pages long, while it does make a reference to digital service taxes, clearly also including the equalization levy, it's ambiguous on what the other offensive measures would be, the other measures that would be considered necessary for removal. Now, there were indications from public statements by certain officials that the direction of travel might be to develop a framework for assessing other types of measures. This might look at things like whether the measure in question makes reference to metrics such as market penetration, the amount of revenue generated from a jurisdiction, whether it references the number of users in a jurisdiction or something like that, because this would indicate that this is a measure directed primarily at digital businesses. But then the further question comes in, if you fall within that category of a measure, is it harmful? I mean, if a jurisdiction has a very extensive tax treaty network, perhaps the conclusion is, well, actually, in virtually all instances that would affect other inclusive framework members, this will be blocked. So in practice, it's not an issue, and we shouldn't spend time pursuing the repeal of that measure. Other measures that might be in scope, and if you think back to 2018 and the issuance of the interim report, they identified 4 types of measures, one being turnover taxes, so equalization levies, digital service taxes, one being virtual PE concepts like SEP, and the other being expansive use of withholding taxes. So whether withholding taxes are written very widely, expanded definitions of royalties to cover digital service payments, perhaps that will be a focus area. Also, potentially, and this was also included in the interim report, measures like the UK DPT or the Australian MAL, which are anti-avoidance measures directed at avoidance of PE. But it may be seen that these are directly targeted at digital companies, even if they can go wider, and perhaps that's also in the sphere. So perhaps what we're going to see in October is a defined framework for assessing these measures, but determining finally which measures need to be rolled back, that may take a longer time period.
Thanks. And maybe Hasnain, I'll also want you to chime in here, because obviously, as Hari mentioned, the draft rules had come out on profit attribution following the SEP under the domestic law, and now we haven't yet seen that getting legislated in that sense. But if you could comment on that, as also comment on this whole bit on reallocation of group profits to market jurisdictions. How does that interplay with the existing transfer pricing methodologies that we have? Sort of it, in some sense, it goes beyond the existing ALP standards that we have under the law. So if you can comment both on the SEP as well as on this interplay between the reallocation and the existing arm's length standard.
Sure. So see, as Conrad mentioned, SEP is something which was meant to bring the digital economy into the ambit of taxation. Now, by and large, India has treaties with 90 countries, and out of the 132 countries which have agreed in the inclusive framework, effectively today this SEP is non-operative, non-effective, and harmless. But for these other countries which are not having treaty, it definitely impacts, because the thresholds which have been prescribed under SEP are very low. So effectively, since in accordance with the statement which has been made and released there's a commitment to remove all these harmful measures. So India will have to either, I would say, make this non-operative for the non-treaty countries, or effectively dilute it to such an extent that it doesn't create any kind of harmful situation for these countries. And linked to that is actually the draft rules which were issued in 2019. And if we see in that, India has been contesting that there has to be significant allocation of profits to the market jurisdiction. And in that, they had come up with a basic premise to say that 1/3 should get taxed to the market jurisdiction. But the way the formula was worked out, it actually landed up much more than 1/3 being allocated. Now, one side we have the FAR allocation, which looks at the supply side, and the other extreme is where India is coming and saying significant amount of profit should be taxed to market jurisdiction. And here is where India has also agreed to amount A allocation, which is some kind of a consensus midway bargain kind of a thing. So, India will also have to move significantly away from that particular formula which has been prescribed under the draft rules, and they will have to realign those to something what is agreed in this some shape and form under amount A. So that's on the SCP and the CBDT rules. But a very interesting question on whether what's going to be the interplay of transfer pricing rules, current rules with this particular new format. Let's understand that this new taxing right over amount A is actually will operate as a overlay on the existing taxation rules. So currently the amount A is an allocation to each market jurisdiction based on the global profits, a share of the residual profit. And the current transfer pricing rules, they are based on FAR. Now, at the first instance, each and every MNE will continue to transact and deal and follow the arm's length principle when they are dealing with their group entities. However, when it comes to this particular amount A, which is under pillar N for the scope entities, that is where the allocation of a part of the global profits will happen to these particular market jurisdictions. So effectively what we are saying is, first, all entities will follow the arm's length. Second is the allocation, which is formulatory, the amount A, and that applies only to a very minuscule number of groups. So we are talking about 100 or less than 100, some saying 120. Thereafter, under the pillar 1 itself, we have this particular concept of marketing and distribution safe harbor rule. So what this rule does is it tries to cap the residual profits which will be allocated under amount A to the market jurisdiction. Effectively, it means that there is a interplay between TP. So whatever has been allocated in the TP allocation, that will be compared to the safe harbor. To the extent that TP allocation is less than the marketing and distribution safe harbor, then there will be an allocation to the market jurisdiction. But if the ALP profits based return is higher in that jurisdiction, then there is nothing further to be allocated. And this doubt is coming because there is a lot of literature articles coming about, debates happening. Is this the beginning of a move to destination-based taxation? Where I would say that there are elements of destination-based taxation, but it is not a pivot towards destination-based system. It is simply an allocation of a small amount of the global profits to a market jurisdiction. And this is coming from the fact that there's now, for the first time, a recognition of the fact that in the value creation, there is a role of markets and consumers. And this is exactly what India has been all along contesting, that don't look at the supply factors, which is FAR, also give weightage to market factors and demand in the basis of looking at this particular entire profit allocation. So there is a move which India has been saying to move from FAR to farm, where M is relating to markets, and exactly this is being recognized in this particular thing. So according to me, there is going to be a significant interplay. TP rules are not going anywhere. That will still be the premise. It's only M which is being worked out on a formulatory approach, and that too for a very limited companies.
Thanks, Hasnain. And I'm conscious that we need to move to the next pillar as well. So, but last final question to Conrad before we move on is that, what do you see, Conrad, could be some of the pressure points for a developing country like India? I mean, there are still some open issues around the percentage of residual profits to be allocated, whether it's 20%, 20 to 30% as a range being spoken about. What about thresholds? What about this the safe harbor, marketing and distribution safe harbor? So what do you think would be some of these pressure points as we get into October?
Oh, you're certainly right. There's a number of key features in Pillar 1 that are yet to be set, which will be quite determinative for how much developing countries get in terms of additional taxing rights. You've already mentioned the exact percentage of the excess profits to be allocated to markets. At the moment, the inclusive framework statement says between 20 and 30. So where will it end up? Will it end up somewhere in between? Obviously, a key consideration. The safe harbor, as you mentioned. So if the safe harbor is designed in a way that it frequently exceeds the reference TP profits in the market, then you will have amount A allocated to the market jurisdictions.
I think we've lost Conrad a bit. So maybe while Conrad comes back in, Hasnain, maybe I'll pull the next question to you. Sorry, yeah, Conrad, please go ahead.
Sorry, yeah. So maybe then the marketing and distribution safe harbor will exceed that. But if, for example, the reference TP profits in the market include manufacturing profits, then maybe the reference TP profits are higher than the marketing and distribution safe harbor, and they're consequently then consequently there may be no amount A allocated to the market. So that design is a crucial matter. Also, as mentioned before, whether the withholding taxes are considered to credit against amount A, that would diminish the amount A allocated to the markets. Also a key consideration for many developing countries that do apply extensive withholding taxes. And then I suppose a further point, which I think is particularly relevant in a China and India context, is the selection of the paying entities. So to give you an example, let us say in China you have an entity in the luxury sector, under the market premium concept in China, which I believe is also used in India on occasion, you would allocate a lot of profits to that entity. Now, that may mean that within that global group, China or India become the paying entity and then are absorbing the liability for amount A allocated to other markets. And so that would impact on their allocation. So there's a lot of technical features to be set, which will be key in determining what India gets out of this, what China get out of this, and what developing countries generally get out of this.
Okay. Hasnain, there are more questions coming for you, but I'll come back to them. I think there are questions around APAs, but maybe in the interest of time, we'll take on Pillar 2 first, and then we'll come back with further questions. Hari, over to you for Pillar 2.
Thanks, Naveen. Can we just move to the slides, please? Now, while the slides load, and before we start talking about the rules that are covered in Pillar 2, let's get a couple of preliminary points out of the way. And the first one is that Pillar 2 is, in a sense, completely independent of Pillar 1 when it comes to the way it is structured and the way it applies. So virtually nothing that we talked about in the context of Pillar 1, including the applicability, the thresholds, the exclusions, etc., will directly apply to Pillar 2. And we will be talking about something that's an entirely new set of rules here. The second point is, even if, can we move to the next slide, please? So even in terms of what Pillar 2 tries to do, the object is quite different from Pillar 1. And this is something that Naveen mentioned earlier on. We are not talking about new nexus and profit sharing rules in Pillar 2. What we are talking about is to ensure that large internationally operating businesses pay a minimum level of tax. So this is really a move towards global minimum taxation. The rationale, again, is fairly straightforward. It's to disincentivize companies from shifting profits to low tax jurisdictions on the one hand, and on the other hand, to ensure that countries don't feel obligated to offer incentives that they cannot afford, and thereby engage in what's called a race to the bottom. There's also a recognition that these rules should not lead to double taxation or end up taxing income where there are no real profits. And whatever has to be done in a way that doesn't lead to a very significant increase in compliance costs. And all of these considerations will form part of the structure of the rules that we will see going forward. The way these rules work is also fairly interesting. The OECD, of course, is essentially an international body. It doesn't have the power to force countries to change their tax policies. But what this means is that when we talk about a global minimum tax, no country is going to be forced to levy an income tax when it doesn't want to. There's not going to be any compulsion to increase tax rates or to withdraw incentives. But the way the rules work is this. if countries choose to not levy an income tax or choose to provide incentives or choose to give very low tax rates, then other countries are allowed to step in and tax that difference. Now, the rules of Pillar 2 will tell us which country will get the right to come in and step in and collect this top-up tax and what's the amount of the tax that it can collect. But these rules that figure these points out are really the essence of Pillar 2. And like in the case of Pillar 1, Pillar 2 proposals will be also implemented between 2022 and will come into force in 2023. And as we will see in the next slide, some of the elements of Pillar 2 will get implemented through treaty changes, and some of them will get implemented through changes in domestic law. Can we move to the next slide, please? So Pillar 2 is made up of 4 different but somewhat connected rules. We'll briefly talk about what each of them is intended to do, and then we will go on to a more detailed discussion of some of the relevant points. The first rule that we will talk about is what's called the subject to tax rule, or the STTR, which at its core is nothing but an incremental withholding tax on certain payments in cases where the recipient of that payment is not adequately taxed in his home jurisdiction. We'll get into the mechanics. We'll talk about what's covered and what's not a little later on. But this is the first rule, the first component of Pillar 1 that we will talk about. The second and the third rule are linked. The second rule is called the Income Inclusion Rule, or the IIR, which somewhat operates like a CFC at a conceptual level and allows the country of the group's ultimate parent entity to levy a top-up tax if overseas subsidiaries are not adequately taxed below what's agreed to be the global minimum rate. The threshold for what will be adequately taxed under the IIR is going to be different from STTR, and this again is something that we will talk about a little later on. The third rule, which is the undertax payment rule, or the UTPR, is a fallback rule, and that will apply in cases where the parent entity's country chooses to not levy or collect the IIR. In such a case, certain countries will be given the right to disallow certain deductions in order to recover the top-up tax that's collectible under the IIR. The IIR and the UTPR, the two regimes that are on the bottom of your screen, are together called the GLOBE rules, and both of these will be implemented through changes in domestic law. The last rule is called the switchover rule. This is less relevant in an Indian context, and it typically applies in situations where you have the exemption method followed for giving relief for double taxation in respect of income of a permanent establishment or a branch. Not many treaties have this in an Indian context, so we really won't be spending too much time on this. With this quick background, let's move on to a discussion on STTR and how it operates. Now, as I mentioned in the earlier slide, STTR allows paying countries to levy a top-up withholding tax if the particular payment in question is not adequately taxed in the receiving country. Now, this rule does not apply to all payments. It only applies to a list of identified covered payments which are set out in the rules. And that too only when they are made to related parties. So third-party payments are not going to be covered by the subject to tax rules. The list of covered payments is still being finalized, but for now we know that it will include interest, it will include royalties, it will include certain kinds of franchise fees, guarantee fees, payment for use of movable property, certain kinds of rental payments for those properties, consideration for some marketing services, procurement services, etc. Because this is an element of Pillar 2 that is of keen interest to developing countries, there is a fair bit of negotiation going on to expand the scope and get more payments covered within the scope. Developing countries are trying to expand the list, and that's something that we will come to know when the final rules come out in October. The one important point here to note is that there is also talk about whether the STTR should apply to capital gains, and we are talking about capital gains that enjoy the benefit of double non-taxation. We know that under a few of India's treaties, we have grandfathered capital gains benefits, which gains are usually also not taxed in the country of residence. So this expansion of the STTR to cover those is something that we may need to watch out for as well. Now, the way STTR is going to be incorporated into tax treaties is by a process of countries requesting inclusive framework members. So what it essentially means is that certain developing countries who have a GDP, per capita GDP of less than $12,000 odd can request treaty partners to incorporate the STTR in the relevant tax treaties. And these countries which have regimes that provide for lower tax rates than the STTR threshold have to agree and incorporate the STTR under tax treaties. So this again is a treaty-based implementation mechanism. I mentioned that the trigger rate for STTR, that is the minimum tax rate below which an income should be taxed for STTR to get triggered, is different than the 15% that we've heard in the context of the GLOBE rules. This is expected to be in the range of between 7.5% and 9%. And this rate will apply on a nominal basis to the payment in question, and it's not got to do with the effective tax rate of the entity itself. So what this means is that if a particular payment is being made, and that payment is being subject to tax in the recipient's country at a rate below 7.5 or 9%, then in those situations, this incremental withholding tax under STTR could get triggered. There was talk of putting in place a materiality threshold for STTR in last year's blueprint, but there's no mention of it in the statement that came out last month. So of course, this was a short statement, so we'll have to wait and watch to see if there is some sort of materiality threshold in terms of the size of the group or the quantum of related party payments that gets incorporated when the final rules come in October. And finally, like in the case of Pillar 1, there are exclusions envisaged for certain kinds of businesses from STTR, which will include investment funds, pension funds, NGOs, etc. Let's move on to the next slide and take a very simple example of how STTR will work in an Indian context. We have a fairly simple inbound structure in this slide, which involves an Indian entity that's part of a UK headquartered group. This Indian entity, you will see that it makes two payments. The first is a lease payment for certain movable property that it makes to the Dutch group entity, and it also makes a royalty payment to its parent entity in the UK. For the purpose of this example, we are assuming that the STTR trigger rate is agreed at 7.5% and that the STTR rule gets incorporated in India's treaties with both UK as well as Netherlands. Let's talk about the payment that India makes to Netherlands first. So here we'll assume that no withholding tax applies in India because the rental payment for use of mobile property does not fall within the royalty definition under the India-Netherlands Treaty. And we'll assume that the Dutch entity does not have a permanent establishment in India either. So as a result, we follow the no PE, no tax rule, and there's no tax withheld in India on this payment at all. We'll also assume that this this lease payment that is made to Netherlands is taxed in Netherlands, but it taxed at a concessional regime which applies a 5% rate. Now, the payment for use of movable property is a covered payment. The payment is made to a related party, and therefore we will have to test for STTR applicability. And in this example, because the 5% tax that Netherlands applies is lower than the assumed STTR trigger rate of 7.5%, the difference between the two, which is 2.5%, becomes taxable in India as a top-up withholding tax that the Indian company will have to pay on the payment that it makes to the Dutch co. So this is really a simplistic example of how STTR will work in an Indian context on certain covered payments on which we don't have currently under the existing rules any withholding tax at all. Now let's take the other example where the royalty payment is being made to the UK entity. So here we are assuming that under the India-UK treaty, a royalty withholding of 10% applies on the royalty. And under UK domestic law, we'll assume that this royalty income is exempt entirely, perhaps under some sort of IP box regime or whatever. And this is just an assumption for the purposes of this example. In this case, even though the UK tax on this royalty income is lower than the threshold of STTR, the STTR is lower than the STTR trigger rate of 7.5%, we would still not have an incremental withholding tax under STTR because Indian withholding of 10% already exceeds the STTR trigger rate. So in essence, this is how the STTR will work on different kinds of payments. The expectation is that because India is an entity where a lot of related party payments are being made by Indian entities, the Indian government will try and see if the scope of STTR can be expanded and possibly to cover other forms of service payments, to possibly cover capital gains as well. But these are things that we'll have to wait and watch out for in the final rules. Now, let's move on to the next slide, please. What the STTR means at a group level is that if there are tax benefits that are being enjoyed by the group under certain special low tax regimes, for instance, you may have IP box regimes or other financing structures that benefit from low rates, there may be a headquarter company regimes, etc. The benefits under these regimes could possibly get eliminated. They could get partially eliminated, at least up to the level of the STTR trigger rate, whatever that's agreed on between the 7.5 and the 9% rate. In an Indian context, ordinarily, our withholding tax on most payments are 10% or higher, but there could be several other payments where we currently go on the premise of no P, no tax, that could get covered by the STTR. We know that there are certain interest payments under 194 LCLD that are currently taxed at 5%, which is lower than the threshold. But we'll have to wait and see how the implementation of STTR translates to domestic law withholding requirements and whether we will see any changes to domestic law to modify these sort of interest payments. And if that's implemented, we could see an incremental withholding tax up to 7.5% or 9% in India on some of these payments. There are a couple of other points that on STTR that we will request Conrad to come in a little later. But for now, let's move on to the GLOBE rules. If you move on to the next slide, please. As we saw earlier, the GLOBE rules comprise of two rules. The first is the income inclusion rule, which is a top-up tax on the income of low-taxed overseas subsidiaries. And the second is a supporting UTPR, which denies deductions if the low-taxed income is not subject to tax under the IIR. There is a threshold of euro 750 million envisaged for the GLOBE rules. Note that this threshold, we still don't know what the threshold will be for STTR, but for GLOBE, it is expected to be 750 million. But countries are given the flexibility to use a lower threshold only for the purposes of the income inclusion rule if they are so inclined. The GLOBE rules kick in if a particular entity of the group is taxed at below 15%. This 15% is to be tested on the basis of an effective tax rate or an ETR calculation, which is really central to this entire GLOBE rules. And we'll talk a little bit later about how this ETR is to be calculated. Again, there are some exclusions envisaged. There are some sectors which are excluded. If you look at a very simple example in our structure, you have a Luxembourg entity that has a low tax, that has an ETR below the global minimum rate. And in a case like this, the first right to tax this undertaxed income would go to the global parent, which would be the UK, which would be the UK. And for whatever reason, if UK chooses to not levy the IIR, then the right to collect that top-up tax will shift to an Indian entity or other group entities which make deductible payments to the Lux entity. The structure of the undertaxed payment rules is still under debate, and we will have to wait to watch how the final structure looks like. But essentially, it operates in the form of the denial of a deduction. So as I mentioned, if we move to the next slide, please. So as I mentioned, the central point in the, can we move to the next slide, please? Right, thanks. So the central point of the key point in the GLOBE calculation is how the ETR is to be calculated. The first point to note here is that the ETR calculation is not done at a per entity level. It's done at a jurisdictional level. So what this means is that if there is a group with, say, 100 entities in 70 jurisdictions, you'll only have to do 70 ETR calculations, one for each jurisdiction, and not 100 calculations for each entity. So this means that you will have to consolidate the taxes and the tax base for all the entities and for all the branches in that particular jurisdiction for the purposes of the calculation. The ETR formula itself is straightforward enough. The numerator would be the covered taxes, which will include the local taxes paid by subsidiaries and branches in that country. It will include withholding taxes. It will include CFC taxes. And more importantly, it will include the STTR that is paid under the STTR rules in a structure like this. We'll take an example that will make it clear how this works. Important to note that indirect taxes like VAT and GST are excluded from covered taxes. And more importantly, so are digital service taxes like equalisation. The denominator would be the tax base, which is the profits of all the entities in the group under the accounting standards. And there are several adjustments to be made. These adjustments are quite detailed, they're quite complex, and there are many of them. And each of them will have to be done in order to find out the actual effective tax rate. I won't talk about each of them, but there's one adjustment in particular that's important to note from an ETR calculation perspective, and that's called the substance-based carve-out. So what this does is that it seeks to provide some relief in cases where, even though the entity is located in a low tax jurisdiction and enjoys the benefit of a low tax rate, substantial investments in substance of that entity have been made. in the form of tangible assets or employees. So there is a certain carve out based on a certain percentage of the carrying value of tangible assets or the payroll costs, which will help mitigate the impact of how the ETR calculation works in certain situations. There are again detailed rules that will govern how the carve-outs will work in the context of ETR. And once the ETR calculation is done, we then go on to calculating the top-up tax and then allocating that back to each entity in the jurisdiction. Can we move on to the next slide, please? Now, let's talk about a few implementation aspects of the GLOBE rules. The way these rules work is called a common approach rules. And what that means is that countries of the inclusive framework are not required to adopt them, but they must accept it if other countries choose to adopt them in their. So what this means is that if a country chooses to not adopt the IIR or the UTPR, that's fine. But then it can't object if other countries choose to adopt the IIR and end up taxing the low taxed income of entities in that particular country. So it's in that sense, it's not a minimum standards, but it's described as a common approach to. There are exclusions envisaged, like in the case of Pillar 1, this is for investment funds and pension funds. There's exclusion for government entities like sovereign wealth funds as well as NGOs. But we have two additional exclusions here that are quite relevant. One is for international shipping companies, and the other one, which is still under development, is for groups that are in the initial phase of their international activity. So this is an important one. We still don't know how this will be structured, and we'll wait and watch how the scope of this particular exclusion comes up in the final rules. There are some simplification options being envisaged, which are really meant to alleviate some of the difficulties involved in doing this calculation year on year for every jurisdiction in which large groups operate. So there are some simplification options that are being debated. These are again going to be set out in the final rules. So we'll wait and watch how they play out. The last point that I want to mention on implementation is that the design of the UTPR, which is the backup rule, which disallows deductions in cases where the country of the ultimate parent chooses to not apply the IIR. The design of that is still being debated, and it's possible that the UTPR itself could be deferred by some time. That's an important point to keep in mind. So we might be starting only with the IIR when the rules kick in 2023. Let's take a simple example of how the rules work, as well as the order in which they are meant to be applied. We have here a reasonably simple structure with an Indian company as the ultimate parent of the group. We have a South African subsidiary, which is subject to a 20% tax rate in South Africa. No incentives or concessional regimes in South Africa in our example, so it pays full tax. In our example, the South African company is making a payment of, say, $100 to a Swiss group entity, and this payment is a covered tax payment made to a related person for the purposes of STTR. The Swiss entity has a headline tax rate of 25%, but it has two incentives that it benefits from. The first is an exemption that applies to all third-party income. So what that means is that the $50 of income that the Swiss entity receives from third parties is fully exempt in Switzerland. And the second is that the covered tax payment that the Swiss company gets from South Africa, that's subject to a 5% concessional tax rate. At a global level, we'll assume for this example that the trigger rate for STTR is 7.5% and the globe minimum rate is 15%. And let's go about seeing how Pillar 2 will work in a structure like this. In terms of sequence, the first step would be to apply the STTR. In this example, there's a covered payment going from South Africa to Switzerland, and that covered payment is being subject to tax in Switzerland at a rate of 5%. This 5% rate is lower than the STTR trigger rate of 7.5%. Assuming that the Switzerland-South Africa Treaty incorporates the STTR, what this would mean is that the difference between the two, the difference between 7.5 and 5%, which is 2.5%, that will be payable by the South African entity by way of an incremental withholding tax to the South African government. So 2.5 is the STTR amount that becomes payable in this example. So this is step one. We then move on to the globe calculation, which is step 2, and we compute the ETR of each of the entities in this group. We already saw that the South African entity doesn't enjoy any incentives, and assuming that the statutory rate applies directly, the 20% rate is more than the minimum rate of 15% that's envisaged for globe rules, and therefore there's no real impact of the globe rules when it comes to the profits of the South African entity. Now, coming to how the ATR calculation works for Switzerland, we don't really have any consolidation involved because we are talking about a single entity in each jurisdiction for the purposes of our example. We saw earlier that the numerator is covered taxes, which would be the taxes paid in that country. In our example, we know that the Swiss company paid taxes of $5 on the covered tax payment that it received from South Africa. In addition to this 5, we will take up the STTR payment that was paid to South Africa, so the 2.5%. So the total numerator, the total covered taxes in this example would be 7.5. The denominator of the tax base would be the profits of the Swiss entity, which we'll assume to be 100 plus 50, which is 150. And if you do this calculation, you will get an effective tax rate of 5% for the Swiss entity. This 5% tax rate is below the 15% globe minimum rate. So that the difference between 15 and 5, which is 10%, is 10% of the 150 of income that Switzerland earns. So the $15 is the top-up tax that gets calculated under the globe rules. We saw earlier that the way the globe rules work, the first right to collect this $15 of tax is with the global parents country, which in our example would be India. So assuming that India adopts the IIR, the $15 of top-up tax pertaining to low-taxed income in Switzerland would have to be paid to the Indian government. If for whatever reason we assume that India does not levy an IIR at all, then the right to collect the $15 of top-up tax will shift under the UTPR to group entities that make deductible payments to group entities. And in our example, what that would mean is that South Africa would get to disallow that much of a deduction on the payment made to Swissco that would get it an incremental $15 in revenue. In our example, that would mean that out of the $100 of deductible payment that South Africa makes to Switzerland, $75 of that would be deducted and the incremental tax would get collected by the South African government. So this really is a very, very high level example of how the calculations work in a simplified manner. We've not considered many aspects, including consolidation, adjustments for temporary and permanent differences. We've not considered carry forward rules. We've not considered a substance-based carve-out and many more of the nuances that are there and that will be further incorporated in the rules going forward. So each of these nuances are themselves quite relevant and will make the difference between whether Pillar 1 applies in a particular situation or not. With that, let's move on to the last slide where we'll talk about the potential impact that the globe rules could have in an Indian context. I won't spend too much time here. We'll hand over quickly to Naveen for a discussion with Conrad. But effectively, this could affect groups that operate in countries that have no income taxes or have low taxes or have all sorts of incentive regimes, including weighted deductions, R&D credits, tax holidays, headquartered regimes, and so on. There could be any number of incentives that could get affected. So structures that involve that use entities in these jurisdictions could get affected, and deductible payments made by Indian entities, whether you're part of an inbound structure or an outbound structure, could also be potentially hit by the STTR. So with that, I'll hand over back to Naveen to take it forward on a practical discussion on Pillar 2.
So Hari, just since your last point was an example, I think there's a question flashing on that example. So if ETR is calculated at the year end, but the covered payment is happening during the year, is the adjustment required to be made only at the year end?
So I think the difference is that the ETR does not, the withholding tax on the covered payments happens under the STTR, which does not require an ETR calculation. The STTR operates on the basis of a nominal tax rate that applies to that payment in question. So in our example, we saw that we know that Switzerland gives you a concessional regime of 5% on that particular covered payment. And because that's known at the time of making the payment itself, we would be in a position to apply the STTR without having to go through the process of ETR. The ETR calculation is something that we would use only for the purpose of IIR and UTPR under the globe rules.
All right, thanks, Hari. So Conrad, I'm going to ask 2-3 questions together, just in the interest of time. And one is with respect to incentives, and we've been hearing about how China and UK are looking at some incentive being excluded from the scope of Pillar 2. So one is is that a real possibility, and what sort of incentives could be carved out or could be covered or could be kept as an exclusion? That's the first part. Second is that countries which already have, say, a low tax, I mean, countries like UAE, where there is no income tax, is there a possibility that some of these countries may introduce one before 2023? And could we see similar moves being taken by other countries to either increase their tax rates or end their incentive regime? And the third part is that our country is also going to look at some sort of non-tax incentives as a substitute for these tax incentives, as a means of making it more attractive for companies to go and invest.
Okay, three very good questions. On the first question concerning the search for exclusions, the UK, as we understood it, was mainly focused on excluding financial services from Pillar 1, given the significance of financial services for the UK economy. And of course, in Pillar 1, there is that regulated financial services exclusion. So in a sense, they achieved their goal there. For China alongside countries like Poland and Hungary were quite vocal in the run-up to the inclusive framework statement issuance at the start of July, that they wanted to see certain incentives that they offered protected. For example, the Polish referenced manufacturing incentives that they had, and they wanted to make sure that those wouldn't be badly affected. Now, the inclusive framework agreement, the final sentence, in fact, or the final paragraph rather, makes a statement to the effect that the objective of the rules is that they should not impact on multinationals with real economic activity, with economic substance. So that's a bit of clarity around what they're trying to achieve, but it wasn't set out explicitly what that would mean in terms of the final rules. I mean, obviously we have, and Harry explained it in good detail, the quantitative substance exclusion, this markup on tangible assets and on payroll, but are we thinking of something further beyond that? There is suggestions that there could be further tweaks, further modifications to the way the ETR numerator or ETR denominator are calculated that would give a greater kind of exclusion for companies with incentives. But certainly it doesn't seem like they're looking at doing anything along the lines of what was earlier requested by some jurisdictions, which was to exclude any entity whose incentive has passed the review of the form on harmful tax practices. That seems to be definitely be off the table, but there may be something else. I think in terms of incentives, and Harry already mentioned it there, was in relation to this delay on the UTPR. Because if you consider, if there's a group that in their parent jurisdiction are benefiting from incentives, and that's driven their ETR beneath 15%, then at least for the first few years of the operation of the rules, they would not be affected. Because to the extent that the parent is not subject to the IIR, you would need the UTPR to pick up low tax in the parent jurisdiction. But if the UTPR is delayed, that gives a transitional period for that company to change its arrangements, and indeed for that jurisdiction to transition to other types of incentive. And I think then that links to your second and third question, which is what will countries do now? And certainly we're aware of a lot of ASPAC jurisdictions that have started at a policy level to start to consider, would grants or subsidies or reductions in payroll taxes, perhaps even refunds of output VAT, things like that, be a good substitute for corporate tax incentives going forward. If corporate tax incentives are simply going to be clawed back through Pillar 2, maybe that's a better approach. Now, any kind of financial benefit, be it a grant or a subsidy or a refund of another tax category, like social security contributions, that's still going to come into the ETR calculation, but more than likely it would come in as an element of the ETR denominator rather than the numerator, which would have a far more muted effect on the ETR of the company and maybe more effective. But of course, there's a number of other considerations there. For example, you may have heard in the European Union, the European Commission has put forward a directive which would require foreign non-EU groups with operations in the EU to disclose all of the grants and subsidies and other tax incentives that they were getting if they were going to make a major acquisition in the EU, because this would be seen as an element of unfair tax competition. Now, that's not going to impact every group, but to the extent that certain jurisdictions within ASPAC were maybe thinking of steering towards grants and subsidies, that would be a consideration. And it could well be that other countries become very conscious of a shift to subsidies and grants post BEPS 2. The final question you were asking about was in terms of changes to tax regimes. And certainly in ASPAC, we're very aware that some jurisdictions are starting to look at alternative minimum taxes. So the whole idea that if there's an entity in your jurisdiction and it's part of a group that's subject to Pillar 2, and if you give them a tax incentive, that's just going to be clawed up by another jurisdiction in terms of tax imposed. So why not impose an alternative minimum tax to top up the tax in the jurisdiction? And the interesting thing about that is that may have an interlinkage with the way they design the whitelist for Pillar 2. So if they ultimately say, look, any jurisdiction that has an alternative minimum tax that would cover companies caught by the scope of Pillar 2 and tops them automatically up to 15% is not a concern for us. And if a multinational has a subsidiary there, they don't need to do all these ETR calculations and so on, which might make, actually, oddly enough, jurisdictions that adopt alternative minimum taxes in a way kind of attractive, because it excuses the multinationals from the heartache of doing all these calculations and compliance.
Okay, I'm conscious of time, so I'm going to ask one question to each one of you, final question, and just we should try and keep it short. So I think, Hari, from your perspective, what do you see are implementation challenges, particularly for groups which are headquartered in developing countries like India?
Thanks, Naveen. I think we've already spoken in terms of how the calculations are detailed and what sort of practical challenges that companies will face in doing these. But I think the bigger challenge, at least from an Indian perspective, would be that the way these rules are structured, they're very different from what we are used to in India. I mean, our rules, our laws are far more conceptual and don't have this level of detail in terms of steps and methodology. So it'll be quite interesting to see how Indian administrators and even the judiciary are able to adapt to these sort of rules going forward. So that's, I think, an interesting thing to watch out for.
Okay. Hasnain, back to you. And this is more to do with Pillar 1. And it's to do with APAs. And APAs, as we know, are typically, driven by, or, the amount of profits which that is already agreed as part of the APA to be earned by the taxpayer. So what will happen to such APAs now going forward under this new profit reallocation that is envisaged under Amount A?
Okay, so see, let's understand that this particular new taxing right in Amount A is actually an overlay to the existing taxation rules. So what happens, the Amount A is an allocation to each jurisdiction based on global profits and some multiple other factors. So the amount is calculated independent of each domestic entity's liability under that particular domestic law. Whereas the APAs actually get calculated based on the FAR profile, and it is qua that particular entity. So in fact, what happens is once all the profits are allocated based on the TP rules or as what is agreed in the APA, that the net amount to be allocated to market jurisdiction under Amount A is going to be worked out. So that clearly shows that Amount A will not come and interject with the tax liability of that particular entity within that particular domestic jurisdiction. Again, APA is signed by the government qua that particular specific entity. And it may so happen in that entity, in that jurisdiction, there may be so many entities. So one of the entities may just be identified to facilitate that receipt of payment. So I do not see any kind of a issue or interference with the APs which are already signed or that may be signed. And at the end of it, just let's remember one thing, that what we are talking about a very, very few limited number of companies where this question can come up. But again, there I do not see this particular APA getting any kind of adverse impact.
Okay, and final one for Conrad. Conrad, on the timelines. I think we are now looking at some sort of a consensus on all the open issues, and keeping in mind the implementation timelines. Do you believe it is realistic? Is there any possibility of there being a slippage? And especially keeping in mind, from a developing country perspective, what do you think will be the most important areas to focus on between now and October?
Yeah, it's a very good question. As mentioned at the start of the presentation, 2023 is extremely ambitious. But then again, part of the issue that arises is that countries that have adopted unilateral measures, such as some of the European countries, have been pretty clear that they will not abolish those measures until such time as Pillar 1 goes into effect. So to the extent that Pillar 1 is held up, that also extends the time for which unilateral measures might be used. And this, clearly from the American point of view, is not an appealing outcome. And certainly from a lot of jurisdictions, and certainly from a business perspective, that's not an appealing outcome either. So there is this pressure to get it done. I think there's also the pressure to get it done partly because of the American political cycle. Now is a kind of a golden time to try and get this done before, well, let's see what happens after that. And certainly the political will seems to be there, but technically it's just such a massive undertaking. You cannot exclude the possibility that at least part of the program will be delayed into the future. And I mean, I suppose we didn't touch on it in great detail, but Amount B. I mean, Amount B was earlier a key focus area. Clearly, it was very hard to get to agreement on that. Now they've said at the end of 2022, we'll try and come up with proposals essentially. But you can see even already parts of the program have been prioritized in the sense that that's been perhaps a little bit deprioritized. So let's see what else gets prioritized or put a little bit to the back of the queue as they try and rush towards implementation. It does look like Pillar 2 is the most advanced in terms of where they are with it. If I had to bet on what does start at the start of 2023, I would have said Pillar 2, the IIR and STTR. But let's see.
All right. I think this topic can go on, and I think I would like to thank all my fellow panelists for this engaging discussion on a very significant yet complex topic. And we will continue to bring you more such webinars in the future as things evolve and progress on both these pillars. Clearly, a replay of this webinar will be available for those who are not able to join today. And we'll also be sharing a document on some of the key considerations and watch points for all the taxpayers as these developments take shape. So once again, thank you for joining today and have a good day.
Okay, thank you.